The steel market in recent years? It's been pretty bleak, honestly. Take our main steel market street in Hunan, for instance. It used to be bustling with shops and customers, but now it's like a ghost town. Hardly any customers and many shops have just shut down.
Another video was shot in China's largest national-level steel specialty market located in Foshan, Guangdong. Named Halting Steel World, it has lost its former prosperity, with streets now deserted and no customers coming in to buy steel products. According to Chinese media reports, since 2021, the construction market has faced an unprecedented downturn, leading to a steep drop in steel sales. Merchants are increasingly distressed, lamenting their inability to sustain their businesses. A merchant at Halting Steel World revealed that they are now losing over 100,000 yuan a month. In this market, several business owners are incurring monthly losses exceeding 500,000 yuan, about $70,000. Reports indicate that in areas surrounding Beijing, the steel industry has also lost its previous bustling activity. Gone are the scenes of overnight queues for goods and the scarce availability of steel transportation vehicles. The market is now bleak, with few customers and only a handful of workers processing steel. Some steel merchants have even closed their doors, with no steel products visible in their yards or warehouses. The steel market is not just quiet. Steel processing plants are also suffering significant losses. Li Gang, the joint president of the China Metal Material Circulation Association, stated that over 70% of the 2,000 steel processing enterprises are running at a loss, including 500 large-scale enterprises with an 80% loss rate. Out of 38 listed steel companies, only 8 were profitable from January to September.
You won't believe it, but like 90% of the steel mills around here are losing money. Even the big guys are feeling the pinch, with losses over 1 billion yuan in just the first half of 2023. And the worst part? The real tough times for the industry haven't even hit yet. With real estate going down, steel and construction materials are the first to suffer. There's talk about steel mills cutting back production to balance things out, but steel is a big deal in many parts of China. Cutting back means a lot of families could be out of work.
Currently, numerous steel plants in China have ceased operations, with some even sending workers on early leave, halting their work and plunging their lives into difficulty.
Oh, and there's this recent thing with Dingsheng Steel Factory in Fujian. They've stopped production and sent their workers on a long break, paying them just 880 yuan a month to get by. That's only $133. The workers are worried they're basically being laid off without saying it outright. Dingsheng says they've been closed for a year, and whether they'll reopen in 2024 depends on how things go. It's not just them, though. A bunch of steel mills ended up shutting down by the end of 2023. The steel industry is really struggling right now, so these shutdowns aren't exactly a surprise.
According to Chinese media, the notification of the holiday leave was unacceptable to the employees. Some workers viewed it as a disguised layoff and hoped to be formally dismissed. Employees of Dingsheng Steel expressed that the company verbally notified them of a pay of 70% of their normal wage, which, after deducting insurance, amounted to merely 880 yuan. A worker struggling to make ends meet said, "I have to support 2 children by myself, and my parents are both 65 years old. 880 yuan per month is definitely not enough for our living expenses." Another worker suggested, "If the company is in trouble, they should just lay us off, and we can find other ways to make a living." One employee mentioned, "To find a new job, we need a termination certificate from our current employer. Without it, no company will accept us. To get the certificate, we have to voluntarily resign." Fujian Dingsheng Steel Company Limited, established in 2017 with a total investment of 16 billion yuan, about $2.2 billion, has factories covering an area of over 2 square kilometers. It's worth noting that the steel plant is not an isolated case. Unable to carry out normal production and business activities, a steel furnace material company in Lianyungang, Jiangsu, announced an early holiday leave starting December 1, 2023, with departments like the scrap steel workshop and maintenance team ceasing operations and taking turns on duty. During the holiday, salaries are paid according to Donghai County's minimum wage standard of 1,840 yuan per month, about $258. The resumption date for production and business activities has not been announced. A steel company in Baotou, Inner Mongolia, also ceased all operations from November 28, 2023, and began arranging for employees to take leave, with the resumption date to be announced later. According to information circulating online, a private steel enterprise in Linfeng, Shanxi province, started its holiday shutdown on November 15th, with workers gradually returning home, as shown in related videos. A steel plant in Henan began arranging for employees to take leave from November 1st, with their compensation during the leave and on-duty periods calculated at 50% of the basic salary. The company tentatively plans to arrange for employees to return to work on February 17, 2024, subject to official notification. An employee of a steel factory in Sichuan revealed that they are taking turns resting for 3 months without pay. The factory is under great pressure and has not distributed bonuses for 3 years. In addition to shutdowns, some steel plants have faced protests over unpaid wages. In June 2023, numerous employees of Hebei Dilong Steel gathered at the factory demanding unpaid wages, with police maintaining order at the scene. Industry insiders cite overcapacity and environmental regulation as the main reasons for the shutdown of Dilong Steel. An insider in the steel industry disclosed, a large number of steel enterprises nationwide are facing shutdowns or even sales. In some provinces like Shanxi, Hebei, Jiangsu, and Shandong, many steel companies are considering selling assets due to industrial restructuring and broken capital chains. According to data from the China Iron and Steel Association, the primary demand for China's steel industry comes from the construction and real estate sectors, accounting for over 50%. Therefore, the steel industry's prosperity cycle is highly aligned with the real estate cycle. The continued slump in real estate drags down steel demand, leading to a severe oversupply. The real estate industry is a pillar of China's economy, accounting for a quarter of China's GDP. It drives the development of up to 60 related industries, such as construction, manufacturing, and mining. The steel industry is particularly sensitive to the ups and downs of construction and manufacturing, making it an important indicator for tracking China's economic health. Moreover, steel companies provide numerous job opportunities and affect the extensive supply chain in related industries. Currently, the entire Chinese steel industry is shrouded in cold air. Qiu Feng, a worker involved in the steel transportation sector, disclosed that although there is still demand in the steel industry, the market's short-term prosperity needs improvement due to the influence of infrastructure and construction market conditions. Qiu Feng stated, "Frankly, considering the steel market in the past 2 years, it's tough to revisit the industry's heydays. Instead, there are signs of a crisis similar to that experienced between 2010 and 2015. According to Qiu Feng, the average retail price of rebar steel products in 2015 was about 1,600 yuan per ton, approximately $224, compared to around 5,500 yuan per ton, approximately $771 in 2010, indicating a significant drop over 5 years. Market data and performance also reflect the overall situation in the steel industry. Statistics from China Iron and Steel Industry Association show that in the first 3 quarters of 2023, key steel enterprises reported a business revenue of 4.7 trillion yuan, approximately $0.65 trillion, a year-on-year decrease of 1.7%. Their total profit was 62 billion yuan, approximately $8.7 billion, down 34% year-on-year, with an average profit margin of only 1.3%, ranking low among 41 major industrial categories. The head of a leading steel production enterprise in Hebei stated internally that in the coming years, 30% to 40%, or even 50%, of steel enterprises might be eliminated due to market competition. A representative of a Southern steel sales company claimed, 2023 has been the worst year in my over 20 years in the industry. Xu Xiangchun of Shanghai Steel Union said, "Judging the steel industry's performance by profits, it's fair to say these past 2 years have been the worst in over 2 decades. In fact, the steel industry has been in a loss-making state since 2022. According to data from the National Bureau of Statistics of China, in 2022, among 41 major industrial categories, the black metal smelting and rolling processing industry reported a business income of 871.5 billion yuan, approximately 122 billion US dollars, a year-on-year decrease of 9.8%, and a total profit of 36 billion yuan, approximately 5 billion US dollars, down 91% year-on-year. The overall market profit decline was notably prominent among the 41 industrial categories. Financial reports from several listed steel companies in the first half of 2022 showed that a significant drop in net profits had become the norm, with many steel companies incurring substantial losses. For example, Anyang Steel's expected loss in 2022 reached up to 3.3 billion yuan, approximately 460 million US dollars, compared to a net profit of 1 billion yuan, approximately 141 million US dollars in 2021. Other listed steel companies, such as Shanxi Taigang Stainless, Chongqing Iron and Steel, and Bengang Steel Plates, also saw more than a 50% year-on-year decrease in net profits in the first half of the year, with industry insiders once declaring that the industry's winter had arrived. However, the coldness of the steel industry seems to deepen in 2023. Wu Jianhua, a steel analyst at Shanghai Steel Union Steel Business Group, said, "In 2023, steel mills were in a loss-making state for most months, with profits recovering only when steel prices rose in the fourth quarter. Therefore, it is expected that the steel industry's profit level for the whole year of 2023 will be worse than in 2022. Looking at the financial reports of listed steel companies in 2023, it was not only profits that declined, but also other key financial indicators. Many steel companies saw a significant decrease in the net cash flow from operating activities. Ansteel Group's net cash flow from operating activities in the third quarter of 2023 was 2.8 billion yuan, approximately 400 million US dollars, down 55% from 6.2 billion yuan, approximately 900 million US dollars, in the same period of 2022, and down from 10 billion yuan, approximately 1.4 billion US dollars, in the same period of 2021. Masteel Group's net cash flow in the third quarter also dropped to 1.8 billion yuan, approximately 300 million US dollars, a 69% decrease from 6 billion yuan, approximately 800 million US dollars, in the same period of 2022. The company attributed this to the steeper decline in steel prices compared to raw material costs, resulting in decreased gross margins and net cash inflows from operating activities. Gross profits of various steel companies also significantly declined, with Ansteel Group and Chongqing Iron and Steel recording gross profit margins of negative 0.29% and negative 0.39% respectively, entering negative territory. The downward operating trends have also prompted steel companies to tighten their belts, with other financial indicators also declining. For instance, Ansteel Group increased its bill financing scale to save financing costs, with its bills payable in the third quarter amounting to 15.9 billion yuan, approximately 2.2 billion US dollars, a year-on-year increase of 35.7%. Its long-term loans increased to 3.6 billion yuan, approximately 500 million US dollars, a year-on-year increase of 495%, and its research and development expenses decreased from 565 million yuan, approximately 80 million US dollars, in the same period of 2022 to 357 million yuan, approximately 50 million US dollars, reducing new product trial expenses. The comprehensive economic downturn in China, triggered by the decline of the real estate market, has become a major global event in 2023. Where the Chinese real estate market will head in 2024 has become a major indicator for judging the direction of the Chinese economy. 10 major investment banks and brokerages, including Goldman Sachs, Morgan Stanley, and UBS, collectively believe that the construction activities in China's real estate industry will continue to decline in the coming year. Among them, analysts led by Hui Shan, chief China economist at Goldman Sachs, hold the most pessimistic view. They believe that China's real estate fixed asset investment will experience a double-digit contraction in 2024, with a continued slump in the real estate market expected to reduce China's GDP growth by 1 percentage point. According to Bloomberg, if the views of these major financial institutions are correct, then China's real estate industry will be in contraction for 3 consecutive years, breaking historical records. In 2022, investment in China's real estate sector fell by 8.4%, with the decline in the first 11 months of 2023 reaching 8%. To counter the overall slump and contraction in the real estate market, Chinese authorities have introduced several measures to stimulate housing demand, attempting to revive the real estate market. For example, in November 2023, Beijing and Shanghai relaxed house purchase restrictions, including lowering the down payment ratios for first and second homes. However, analysts argue that buyer sentiment is too weak for these measures to have a long-term impact. On the other hand, a report published in January 2024 by the Guanghua School of Management at Peking University pointed out that China's current real estate market is weak both in supply and demand, with housing prices showing a downward trend. In November 2023, the prices of new commercial residential buildings in 70 major and medium-sized cities fell by 0.7% year-on-year and 0.4% month-on-month. The report states that real estate sales and investment continue to show negative growth. From January to November, real estate investments fell by 9.4% year-on-year, a 0.1 percentage point increase from the decline in the first 10 months. The decline in real estate investment is still affected by the overall downward trend in the industry. Regarding real estate demand, commercial housing sales data continue to slide. From January to November 2023, the sales area of commercial housing fell by 8% year-on-year, and a 0.2 percentage point increase from the first 10 months, and the sales amount fell by 5.2% year-on-year, a 0.3 percentage point increase from the first 10 months. The report, co-authored by Liu Chao, professor and dean of Guanghua School of Management at Peking University, and associate professor Yan Se, highlights that insufficient consumer spending is the crux of the current economic problems. The reasons for insufficient consumption can be attributed to 3 aspects. First, the scarring effect of the pandemic still exists, leading to a lack of confidence and weak expectations among residents. Second, the growth rate of per capita disposable income of Chinese residents has declined, with the income rate growth of low-income groups, who have a higher marginal propensity to consume, being the lowest. Third, real estate and financial investment constitute a significant part of residents' wealth, which has been severely depleted. The report emphasizes that the risks in the real estate sector are underestimated, with the worst yet to come. In 2024, the real estate market is at significant risk of a hard landing, which will negatively impact the recovery of effective demand.